If you're one of the lucky few who actually has a pension, you are staring down one of the biggest money decisions of your entire life. Seriously, it's a choice that kind of creeps up on you, but man, getting it right, that is absolutely critical for a secure retirement.
All right, so let's get right to it. The choice really boils down to this one big question. Do you take a huge chunk of cash, the lump sum, and say, I'll handle this myself? Or do you go for that smaller, but totally guaranteed check that shows up every single month for the rest of your life?
And listen, I am not being dramatic when I say this. The path you pick here, it can literally be the difference between a retirement where you sleep soundly at night and one where you're constantly filled with anxiety. So let's really break down how to think about this.
Okay, so what are we really looking at here? Let's check out the typical menu of options you'll probably see.
Yeah, you're going to see a bunch of jargon here. Single life, that just means it covers you. Joint and survivor, that's the one that makes sure your spouse keeps getting checks after you're gone. But look, before we get lost in the weeds, the real first decision, the big one, is do you want any of these monthly payments at all? Or do you just grab the big bag of cash and run?
All right, let's talk about that lump sum because the argument for taking it is, well, it's super tempting. And it all comes down to one powerful idea: investing in the stock market.
I bet you've heard this, right? Maybe you've even thought it yourself. You see that big lump sum number and you think, wait a minute, the market's average return is in the double digits. Why on earth would I take a dinky little monthly payment that's basically a 5 or 6% return when I could crush that by investing? It sounds so logical. It's a great argument, but it's also incredibly dangerous. And here's why. This is the whole ballgame right here. A guaranteed pension check is not the same as an average market return, not even close. One is a promise, it's a certainty. The other, it's just an average that completely papers over all the wild ups and downs. And trust me, when you start living on that money, those ups and downs are all that matter.
This gets us to the #1 retirement killer for people who take the lump sum. It's called sequence of returns risk. It's a fancy name, but a simple idea. It's not just what you earn, it's when you earn it. Getting a good year then a bad year is completely different from getting a bad year first, especially when you're pulling money out to live on. A bad start can sink the whole ship.
And take a look at this. This is exactly why it's so dangerous. Imagine you retire, you take your lump sum, and bam, the market tanks in your first year. What happens? You still need to pay your bills, right? So you're forced to sell your investments when they're at their lowest point. You're selling way more shares than you should have to. And that just hollows out your portfolio, making it almost impossible to recover, even when the market eventually bounces back. Okay, so the lump sum has this huge hidden risk. What about the other side of the coin? What does that monthly pension payment really give you? Well, in one word, certainty. And this just lays it all out crystal clear. With a pension, you get a paycheck, period. Doesn't matter if the market is soaring or crashing. You can't outlive it. With the lump sum, your income depends entirely on the market's mood. You can definitely run out of money, and its value is a total question mark from one day to the next. But of course, there's always that big what if, right? It's the #1 fear I hear. What if my old company goes bankrupt? I worked there for 30 years, but will they even exist in 20? And look, that is a totally fair question. But there's a huge safety net most people don't know about. And here it is. The PBGC, the Pension Benefit Guarantee Corporation. Think of it like the FDIC for your bank account, but for your pension instead. If your old company goes belly up and can't make its payments, the PBGC literally steps in and makes sure you keep getting paid. And we're not talking about pennies here. For 2025, the max guarantee for a 65-year-old is over $7,400 a month. So if your monthly pension check is less than that, you can basically think of it as being backed by the full faith and credit of the US government. All right, so we get the theory, right? The risks on one side, the guarantees on the other. But how do you actually apply this to your situation? Let's walk through a step-by-step way to figure this out. First, you've got to look at the whole puzzle. How much other guaranteed money is coming in, like from Social Security? And what about your spouse? What do they absolutely need to live on if you're not around? And here's a big one. Could that pension be the perfect bridge to get you from your retirement date to when you finally turn on Social Security? So let's make this real. Meet Bob and Linda. Their choice, a $280,000 lump sum. Or their company pension would give them $1,200 a month and Linda would be totally covered. But here's where it gets interesting. They didn't just look at those two options. They took that lump sum amount and shopped around for a private annuity. And what did they find? They could get more money per month, $13.50, still give Linda 100% protection, and get a death benefit for their kids if something happened to them both. I mean, that's a classic win-win-win. But the absolute best way to make this call? You got to stress test it. Let's throw some curveballs at those options and see which one is still standing when the dust settles. Okay, so here's our next case study, Kevin and Lynn. They've done well, got 1.7 million saved up. And now Kevin has the choice, a guaranteed 36 grand a year for life for both of them, or a check for $500,000 right here, right now. What do they do? Okay, test number one. Let's imagine they retire and boom, a massive 2008-style market crash hits right away. Let's see how their overall retirement plan holds up under each scenario. Wow. Look at that difference. If they take the pension, even with that horrible crash, their plan has a 98% chance of success. If they take the lump sum instead, that drops all the way to 89%. Now, 89 is still pretty good, but you can see that pension acting like a financial seatbelt, right? A shock absorber. But you know what? Let's not stop there. Let's make it even worse. Let's say that market crash happens, and down the road, they get hit with a huge long-term care bill. This is one of the biggest retirement wildcards out there. And this right here shows you the true power of that pension. When you add in long-term care costs, their success rate with the pension is still 79%. Pretty good. But with the lump sum, it absolutely craters, down to 42%. That guaranteed check isn't just nice to have anymore. It becomes their financial lifeline when the absolute worst happens. So this all comes down to one final question you have to ask yourself. That idea of getting average market returns is so alluring, so powerful. But guess what? Your retirement is not going to be average. It's going to be real life, with real market crashes and real unexpected bills. So the question is, are you building a plan for the averages you hope for, or for the reality you might actually get?